Good afternoon. We'd like to call the Finance Committee meeting to order, please. I understand that there are no public comments today, so Doug, would you please, well, let me do the approval of minutes first. A motion, please, to approve our minutes of our September 24th Finance Committee meeting. A second, please. All in favor? Any opposed? The minutes are approved. Doug, can you talk about the work plan, please?
Sure, Mr. Chairman. There are changes to the work plan. Two items that had been scheduled for October are being presented today: the annual review of MTA's derivative portfolio and the MTA 2012 semi-annual investment report. In addition, there's one change to the work plan for November: the review and assessment of the Finance Committee charter. That was done at the September committee meeting, so there's no further review necessary.
Okay, Doug. Now, the budget watch we're going to do on Wednesday at the board meeting.
Wednesday, there's a combined finance board meeting, at which point the November plan will be presented.
Right. So, next item is the MTA headquarters, all agency items. We have an action item.
Finance watch.
Finance watch. Go ahead.
Pat McCoy will do Finance watch.
Thank you. Finance Watch appears on Roman numeral 4-1 of your committee book this month. We have a number of transactions to report. The first two involve termination of swaps between TBTA and Citigroup Financial Products. As you can see here, the first one was effected on September 26th of 2012, where we terminated two of these transactions due to the fact that Citigroup Financial Products, or CFP, was downgraded by Moody's to Baa2 on June 21st. And as you can see here, those notional amounts were $40.4 million and $89.5 million, respectively. We paid a discounted valuation of $22.3 million on that termination. Following that, on October 4th, we also terminated two additional swaps with Citigroup Financial Products. And this narrative here describes what we the termination itself. Again, this termination actually resulted in a slightly better discount than we received on the market termination up above. And again, the first one was done on a market basis. The second one was done on a negotiated basis following the results of the market termination. Next, we turn to the issuance of MTA Dedicated Tax Fund refunding bonds, the Series 2012As. This was on October 16th, we executed a $959 million refunding of dedicated tax fund bonds. It also included some transportation revenue bonds, and you see all the refunded bonds here listed on that table in the report. On the right, you see the statistics here. The all-in true interest cost of the refunding was 3.07% with an average life of 13.28 years, generating 18.36% in savings. This was a transaction was led by Wells Fargo. Any questions on that, or we'll keep going here? Next, we have the credit substitution on the TBTA 2002F. We had a bank, ABN AMRO, on the providing a standby bond purchase agreement. The bank exited the transaction, did not want to renew, so we negotiated a new facility with Helaba Bank to come in place of them. We also switched the mode from a weekly mode to a daily mode, so the bonds will reset on a daily basis, and we think we'll get a better result from that over time as those bonds are reset.
That switch, did that cost us anything?
Well, the switch did cost us in terms of legal fees, and primarily it's legal fees and printing and just our normal costs of issuance. We had no other alternative, though, due to the fact that the bank facility was expiring by its own terms,
right,
with ABN AMRO Bank, and they have not been renewing any. They've gone through their own reorganization in Europe and have not been renewing any of their business in the United States.
So it was something that we actually had to do.
We had to do. We had no option there.
And just for my information only, well, for everybody, what would something like that cost? Fees, I mean, is it
Fair question. I think, typically
100,000?
with ratings and printing and legal fees, I'd say we're probably around 200 to 250,000 for the full 200 and
So it's a good chunk of
210 million
change to move
facility.
it.
Yeah.
Okay.
But as we budget, we build into our budget the need to do this from time to time with our variable rate bonds.
Yeah, but it's still costing us, so we're going that way instead of
Right.
that way.
That's right.
Okay?
Okay.
Our reliance on third parties, on banks and other credit enhancers, I'm starting to feel like we're better than any of them, and I'm wondering why the hell do we need it?
It's a fair point. I will say that our variable rate portfolio performs very well and provides real savings, even with all the sort of the work that we have to do to maintain it. And we do a lot of work to maintain that variable rate portfolio. And as you'll see, as we talk about our year-end transactions, we've had a number of remarketings and credit substitutions that we've had to do this year. That's necessary to keep that portfolio working so you can get those very low rates on the bonds.
What we've tried to do is we've tried to diversify our short-term portfolios, so we have some facilities or programs that have a letter of credit or a standby purchase agreement or a liquidity agreement. We have others where it's just an index priced into the marketplace, where it's really, our credit or stronger credits that are out there. So we're really trying to have a mixture of products, but the number of strong, credit-worthy, banks is diminishing, and the prices have gone up, and we'll see what happens with new heightened capital rules. But I'd say one thing that we have been doing is we have been fixing out a good bit of our short-term financing. And fixing it out because long-term interest rates are so attractive. And if you think long-term rates are attractive, one thing I can say, if it's fixed rate for 30 years, when interest rates start to go up, we've locked it in. And if you do want to have a certain amount of your portfolio in variable rate, well, we're going to be at variable rates when variable rates are higher, just as we are when variable rates are lower. So the one thing, if we can fix more of our long-term capital with, solid fixed rate debt,
Right.
that's an attractive thing to do, and that's what we're looking at.
Okay.
Yeah.
So you were kind of forced into this situation with this one?
With this particular issue, yeah, with
Yeah,
the
okay.
with the bank, yeah. Okay. So speaking of other products, at the top of 4-4, we have a remarketing of $35 million of DTF bonds, the 08B3As, and this is one of those issues where it's the MTA's own credit, and so we don't have a bank involved. And this is a floating rate note that prices at SIFMA plus a spread. We got in and we think we achieved very aggressive pricing on this, 0.23% spread to SIFMA. So a SIFMA is a weekly rate that changes with the municipal market, and then we'll pay an additional 23 basis points on top of that for a period of out to November 1st, 2014. So we did a two-year renewal. So in 2014, we'll come back and we'll reprice that at some period, whether it's 2 years or 3 years or 4 years. But again, I think that's the kind of cost that we're looking to lock in on that particular product.
You've got the human assets on board to manage this kind of deal, right?
Yes, we do. Yeah. Turning next to the TBTA 2009 A1s, and as Bob noted, this is one of those issues where we had an issue of a variable rate bond that needed to be addressed, and we took the option to just fix that out, and that's what we did here. And as you can see, the fix out resulted in an all-in true interest cost of 3.25%, average life of 13.34 years. And this was actually senior managed by Loop Capital Markets, one of our minority-owned firms that's in our co-manager group. They did a good job of covering us on this, and that was a merit assignment awarded to them as a result. Next, we turn to the transportation revenue bonds, the variable rate refunding bonds, 2012 Gs at the top of 4-5, and here we issued $360 million of floating rate notes in conjunction with a refunding of our TRB 02As and 02Es. And what we did is we tranched those bonds out to with reset dates in 2014, 15, 16, and 17. And as you can see here, we priced them at 67% of 1 month LIBOR plus a spread. And the way those spreads were locked in was 42 basis points on the 2-year, 53 basis points on the 3-year, 70 basis points on the 3-year, and 84 basis points on the 5-year. Sorry. So again, when those remarketing dates come up, we'll get back into the market and put them out. Again, there's no banks involved here, and this is an attractive product for us.
Are you seeing more of that? Excuse me, not to be deaf, but are you seeing more of that practice, if you will, among other issuers too?
To use the floating rate note product?
To run their own deals.
Absolutely, yes. We are seeing our peers out there in the municipal market turn to the floating rate note as an alternative to dealing with the banks on every single issuance of variable rate debt. And because we know the auction rate market is no longer functioning, so that is not available to us. So this is a fairly new product that's come into the market. It gives us a good flexibility to get in and out of it. And again, we don't have the complications of a bank and their ratings and so forth and their perception in the market. Okay. As you can see here, the statistics on this, again, this is a refunding and a synthetic fixed rate refunding, all in true interest cost of 4.32%. But again, that's assuming certain interest rates after the reset dates, which we won't know until it's all over. Turning next to the TRB 2012H at the top of page 6 of the Finance Watch. This is a $350 million, just standard new money for transit and commuter purposes. As you can see here, we locked in an all-in true interest cost of 3.7%. So for a 30-year financing, very attractive rates there, 18.64 years average life. This was managed by Siebert Branford Schenck with Duncan Williams and Rice Financial Products serving as special co-seniors on that. At the same time we did that, we also fixed out another series of variable rate bonds right below it, the TRB 2008 B2s, and this was about 110 million of variable rate bonds where we had it was a mandatory put date coming up, and rather than kick that out for another 2 or 3 years, we just decided to lock in those low fixed rates. And as you can see here, we locked in an all-in true interest cost of 2.17% for the life of those bonds, and that life is 8.5 years.
That's pretty good.
Again, Siebert Branford
I
Schenck.
see on the 2012s you're still paying a state bond issuance fee.
That is correct. That's on new money. We are still paying it. I would note that the state's been very cooperative with us this year, and they did give us the waiver on all the refundings that we've done, and there have been a number of those refundings. But on new money, we continue to have to pay the bond issuance charge.
Are we trying to continue to get over that?
I think it's something that we do raise with the state. We do ask them for relief from that, and again, they've been cooperative on the refundings, but on the new money, we haven't been able to get them to move off of that.
But is it something that's discretionary with them, or is their legislation supposed to cover this?
This is something that is built into their budget. They look forward to a certain level of revenue coming in from these fees. Our point in our argument to them was that they were going to have a windfall if they took advantage of these, but right now it is part of it's built into the budget.
It is in fact in statute. The budget director of the state of New York has the ability to waive it, and the decision of the second floor has been that we'll waive it only for refundings, not for new money issues.
And well, I should also say only for us.
No.
I'm not aware that anyone else.
They have done it for the dormitory authority as well, to my knowledge, as well as the large refunding agents have done it.
Would something from this committee or the board as a whole perhaps add a little bit of, not to minimize the cloud that my friend has there, But just to pile on, you know,
I would suggest that might be singularly unhelpful to do that. I think it might be singularly unhelpful to try and press the Bureau of the Budget.
but I mean, the board brings it up all the time,
Yeah.
and so it's obviously something that the board feels passionate about.
I will fashion a letter to the budget director asking him for waiver of this, especially as they're now developing their budget for the next year, which begins in April. Now is the time to make that request available, so we can do that in connection with new money issues, especially in light of the fact that we may be issuing notes, anticipation notes, or to fund some of the liquidity concerns that we'll have in connection with Sandy. So I think it's very important. I think the comment raised is an important one, and we should definitely look into that, not just with Sandy, with all our new money issues.
Yeah, I'd just like to echo all of the comments made by our colleagues. We made a fairly big deal about this last year, and we have in the past. To me, I don't understand how the state of New York can ask us to essentially issue debt on the state of New York and the city of New York's behalf. We're as a public entity, we're only performing a public function here, and then to essentially charge us a tax or a fee for the purpose of doing that, to me, is just compounding the expenses of the agency. I understand that the state relies upon the money. It's something that the state should stop relying upon. And, you know, that's a policy question. And since we now may have to, in the interim, expend some interim financing and all to deal with the latest catastrophe, it would seem like an appropriate time to raise the issue to give us additional budget relief. Thank you, Mr. Chairman.
Okay.
I think there's a question down.
Just to put a footnote on it, I served as a member of the Dormitory Authority. It is a subject that the Bureau of the Budget is keenly aware of, that it acts very discreetly on. It has a whole bunch of policy issues attendant to it. If you, why not him, et cetera, et cetera. To my knowledge, the chair has repeatedly made the point to the second floor about it, as have other agencies, and so far it has been well received. I think you're better off leaving it at that.
It is worth doing it as they're preparing their budget for next year. Once they have it in their budget, it's very hard to have it disappear. It's a lost revenue item. And as you see in the papers today, their revenues aren't coming in as expected, so their tax receipts. So they're going to be reticent to do anything about it in the current year. But we should talk to them about it.
Okay, two final elements on Finance Watch. We had a LOC renewal, or letter of credit renewal with Helaba Bank on November 10th, and that was done for 2 years. And then lastly, just to report on upcoming transactions, we have 2 transactions contemplated for December. The first is Triborough subordinate refunding bonds of about $550 million. That'll just be a refunding of fixed-rate bonds with new fixed-rate bonds at a lower cost to achieve savings. And we're anticipating that for the second or third week of December. And then lastly, we have just a small $30 million floating rate note to remarket. And as we talked about those floating rate notes, we'll report on those as we do them. But again, we're anticipating a good result from that as the market continues to show interest in that product. That concludes Finance Watch, and happy to take any questions if there are any.
Would you take us through the headquarters and agency?
Yeah, we have 3 action items, the first of which authorization to issue transportation revenue bonds, Series 2013A. Pat, you wanna...
This is on Roman numeral 5.1 of the book, and this is just a standard new money issuance for transit and commuter and bus projects. This is anticipated to be done through the Transportation Revenue Resolution, and we would expect to bring this to market sometime in January. And this will be a rotating assignment to Senior Manager Citigroup. So, any questions on this? I think we're for a vote.
Okay. We need a vote on that, yeah.
Okay. We have a motion, please, and a second? All in favor? Any opposed? So moved. Action items approved.
Next item, MTA and TBTA reimbursement resolutions for federal tax purposes. Board action is required to allow for the reimbursement of capital expenditures at a later date from the proceeds of tax-exempt sales. We need a motion on that.
And this is something that we do every year. It's typically in the December work plan. We're doing it now just to bring it to the board. But again, it's something that every year we do, just so that if we expend money out of our operating budget or other funds that we have available for convenience, we have the ability to replace those monies with the proceeds of tax-exempt bonds when we issue debt.
Okay, so we have a motion? Second. All in favor, please? Any opposed? So moved.
The third item is owner-controlled insurance for East Side Access. It's to obtain board approval of the following actions necessary for the extension of MTA's insurance coverage for the owner-controlled insurance program for the East Side Access project. Point 1 is to extend OSIP excess liability policy coverage through August 1st, 2018. The second part would be to extend OSIP pollution liability policy coverage through 12/31/2018 and to adjust the premium to reflect estimated third-party construction cost of $5.75 million. And the third item would be to extend OSIP professional liability policy coverage through 12/31/2013 and to adjust the premium to reflect increased design fees.
Okay, so we have a motion, please? A second, please? Chuck, you want to speak, please?
Since I am not a member of the committee, I don't vote on it, but I would like the record to reflect utter recusal on this item, please.
Okay.
Utter. Conflicts, otherwise.
Okay, so we have a motion and a second. All in favor, please? Any opposed? So moved.
Next, we move to report and information items. The first item is the annual review of MTA's derivative portfolio. Pat?
Pat, you're going to take us through this?
Yes.
Okay.
We're just going to put these slides up on the screen. I think we mailed this out in October. This was supposed to be done in October, and we're just bringing it now. So if we could just go ahead and turn to the first page. What we're focusing on here is our synthetic fixed-rate portfolio. The derivatives program, and this is a board, we have a board-approved policy on this, allows the use of interest rate swaps and options and fuel hedges. And typically, it takes one of three forms here, and the most prominent being synthetic fixed-rate debt, where we talked about that earlier. This is to achieve a lower net cost of borrowing, and it's typically a floating to a fixed-rate swap. It allows us to do interest rate hedges, something we've done in the past. We don't have any active interest rate hedges now. And then lastly is fuel hedges to establish certainty and stability in the budgeting of future price volatility with respect to commodities used by the MTA. And the policy explicitly forbids any sort of speculative interest rate or fuel hedges. Why don't we go ahead and turn to the pie chart here on page 3. And what we're really talking about, if this is our whole portfolio of debt, you can see we're predominantly in the fixed rate mode. Approximately 84% of our bonds are traditional fixed rate bonds. We have what we call unhedged variable rate, just natural variable rate of $2.3 billion. And then here in the green slice, hedged variable or synthetic fixed rate debt of $2.7 billion, 8.5% of the portfolio. And that's what we're going to talk about today, is that green slice of our portfolio. If we turn to the next page, synthetic fixed rate debt is cost effective. We always compare, when we do these transactions, compare the expected costs to what traditional non-callable fixed rate bonds would provide in the market at the time of issuance. Based on the construction of the portfolio, we estimate savings of about $19.6 million relative to the cost of fixed-rate bonds at the time of issuance, non-callable fixed-rate bonds. And as you can see, this translates to a weighted average interest cost of 3.77% on this part of our portfolio versus about 4.4% weighted average cost for traditional fixed-rate bonds. As you can see here, synthetic fixed-rate exposure continues to be what we consider to be manageable at 8.5% of total outstanding debt. And just one thing to note, we do report our mark-to-market valuations on the portfolio. They do not have an impact on the capital or the operating budget. Those are theoretical replacement values that are required under our accounting rules. Sure.
The fixed rate of 3.77%.
That's synthetic fixed-rate cost, right?
Yeah, versus the 4.40.
Right.
The 4.40 is the traditional rate, so we're doing pretty well with that.
That's right. So relative to traditional fixed-rate bond.
Right. Now, when does this swap come in? When that thing goes past 4.4? We're betting on the more. What's the word I'm looking for here? You're betting
Well, the synthetic, the way to think about the synthetic fixed-rate debt is, we'll issue a variable rate bond, call it a weekly or a daily or a floating rate note, and that's going to float periodically. At the same time we enter into that sale of bonds, we'll also execute a contract with a third party, typically a large, well-capitalized bank, and we do have rating requirements that we have to do that. And essentially, our obligation, obviously, is to pay that floating rate on the bonds, and we continue to do that. In turn, our contract with the third party does a couple things. One, they'll pay us a variable rate that should match that variable rate on the bonds. So that sort of cancels out that obligation, or it sort of nets that out, I should say. And then we make a fixed payment to the counterparty. And that's really our obligation. So if you weight those average of fixed rate payments to the counterparties, that's where you get to the 3.77%. Okay.
Pat, is this about the right ratio according to the rating agencies?
I'm sorry, I'm not...
The amount, the percent of variable rate debt plus the synthetic, is that about what the rating agencies want us to have?
They haven't expressed any discomfort with the levels we have. They don't issue any sort of strict guidelines on what they consider to be the appropriate amount. They view that as a policy matter that the issuer needs to determine. Again, given our outstanding portfolio of over $32 billion in debt, this comprises a small part, and it has been effective at times to enter into these transactions. I think in any case, the reports that we see from the rating agencies and the discussions have not raised any alarm bells on that. Okay. Sorry. The cost of the portfolio. You see, again, the bulk of it being traditional fixed-rate bonds, 4.4%, synthetic fixed rate at 3.77, and unhedged variable at 4. Now, that's what we budget at, and depending on the snapshot of time that you look at how the variable rates come in, that could be higher or lower, but that's a conservative budgeting level for that. And our average, when you average this out on the whole portfolio, the budgeted cost is about 4.3% across the portfolio, how we budget, and you'll see that in the financial plan later in the week.
Pat, the one thing is, at some point in time, and maybe this is probably not the time, I do think you're going to have to, as we discussed, look at the percentage of variable and short-term rate versus long-term, because it's inevitable as we go forward here that rates are sometime here going to go up. I don't think they're going to be this artificially low rate forever. And just like we hedge fuel, which costs us money to hedge the fuel, there's no question about that, but we do it for a reason, to even things out. I think we got to be very cognizant of the fact that we have enough longer-term fixed financing here so we don't get clipped if rates should really start to move against us. Because this is really not a environment that I think is a natural market environment, free market environment. A lot of this obviously is induced by the Federal Reserve and the European central banks and all these things, and it's going to change sooner or later. And I do think at some point in time, I think with our experts who we have, who are much more knowledgeable, obviously, than the people around this table that do this all the time, you're going to have to sit down and really have a long-term program, as we do with fuel hedges, thought out.
Good point. I will say that we have very much been on the fixed rate mode. In fact, anytime we've issued new money over the past 2 years, it's been strictly as fixed rate long-term bonds, and we've been locking in those very attractive rates that we see here. So, although there's been as we talked about earlier, there's a fair amount of activity to maintain the variable rate portfolio. We're certainly not growing it at the current time. If we turn to page 6 here, again, I spoke about this at Finance Watch. I won't go into great detail again here, but as you can see here, we did have one of our counterparties was downgraded by Moody's. This was Citigroup Financial Products. We competitively bid a termination of the 2 transactions related to that master agreement, and you see there's one for 88.5, the other one for 88.6 million. These were 5.777% synthetic fixed rate swaps, short remaining life remaining, but we were able to terminate those at about a 95% cost on the dollar. We expect PV savings about 8.5% as a result of this termination. The underlying bonds continue to exist in a variable rate mode. So if we turn to the next page, following what we consider to be a rather successful termination of those first 2, we did have 2 additional swaps with Citigroup Financial Products at an even higher cost. These were 6.07 cost swaps, 3 years remaining. We actually approached Citigroup on this and negotiated a slightly even more favorable termination than what we got out of the market on the other 2. And again, this concluded all of our exposure to Citigroup Financial Products, so we have no more exposure to them. And the bank came back to us and indicated that they have a broader LOC capacity to the MTA as a result of this, and it's something we may try to take advantage of next year as we work on the portfolio. So if we turn the page here, you see these are all of our outstanding swaps aggregated by counterparty, alphabetized here, starting with AIG down to UBS AG, and you can see the notional amount there is back in 2011 was 4.1 billion. We've brought that down to 3 billion, and with natural amortizations, it's even going to be lower than that. And you can see the mark to market. These last 2 columns, that's required under our accounting rules, and those are theoretical replacement values. They have no bearing on either our operating or our capital budgets. So any questions about this, or we'll go on?
The mark-to-market,
Yes.
given where rates are, would you say that is largely attributable to the downgrade of the credit of the banks?
No, the mark-to-market values are really a function of the overall interest rate environment relative to the environment that existed at the time the trade was entered. So at the time our trades were entered, largely between 1998 and 2004, 2005, rates were higher. So we locked in at those rates at that time. Rates have come lower. So what we're dealing with is a lower market environment now than at the time of execution, and that results in this higher negative mark-to-market against the MTA. So this is a situation where the counterparty is exposed to our credit as opposed to us being exposed to the counterparty's credit. And quite frankly, we'd rather be in that situation than any. Okay. So if we move on, just a bit on fuel hedging. We've obviously spent a lot of time on this issue in committee. We hedge a portion of our fuel costs to provide budgetary certainty in fuel expenses. We're currently hedging approximately 50% of ultra-low sulfur diesel, which is our most heavily utilized commodity. We're currently structuring the transactions. We're laddering them in every month to go out about 18 months, and these are cash settled on a monthly basis, so our exposure to the counterparty is a declining exposure over time. Freed up capacity in the portfolio is just recycled on a monthly basis, and that way we can continue to look out 18 months. Every month we just go out another month, again, to provide that clarity when we budget for this commodity. We would just note here that in July 12, we removed Bank of America Merrill Lynch from the approved list of counterparties, and we were actively working to approve replacements. We actually did negotiate successfully with JP Morgan to come in as a replacement, and in fact they recently won our most recently competitively bid fuel hedge. We continue to have Deutsche Bank and Goldman Sachs as counterparties. So anytime we lay these on, they're done on a competitive basis. We've got 3 active, aggressive counterparties bidding on those trades, and we see very, very good results in the bidding. Very little differences down. It's measured in portions of a penny difference, and that's really, I think, to the benefit of the MTA.
Pat, in another few different books, mostly in the bus division, we're purchasing lots of new bus vehicles, most of which are much more energy efficient than our current vehicles are, or at least on a par with the most energy efficient of our current vehicles. Do you anticipate changing any of the fuel hedging procedure based on the type of equipment we have, or is this just something that you would do in any event to try to keep the prices stable?
It's a fair question. We're always looking at, what is the consumption out there, and so the way we're hedging right now is we're basing all of our consumption on what happened in 2011. We do look at 2010 and 2009 as well. So we're working closely with the budget department to make sure that we're not over-hedging or under-hedging as a result of the changing use of fuel.
And the budget department looks at the various operating agencies and speaks to them about the type of equipment they have or will be purchasing?
Yes.
Yeah, one thing I would say is, again, since we're trying to have budget certainty, it's the more volatile commodity that we're concerned most with. And ultra-low sulfur diesel has been much more volatile than natural gas, compressed natural gas, which had a long-term trend going down. As we see those prices rising, we will be looking at that. But really, it's the volatility that's our biggest concern for us because, again, our goal is to try to maintain budget certainty.
Turning to the next page, what we said in October was we're going to expand the fuel hedging program to increase 2-year budgetary certainty, and again that's what the board already has approved. And so again, as I said, right now we're looking at 18-month transactions that give us full clarity for a year and then already into the next year as well. And again, our target is to hedge approximately 50% of consumption over the next 12 months with declining amounts after that. So why don't we go ahead into the next slide. And this is just, again, a slight, we already covered this, but I just wanted to give you a sense of, here you see gallons purchased in the blue, and then if we lay our next data point in, where we've actually hedged, and that's in the green, that's gallons hedged. Again, looking out now. And then you see here what the percent hedged is. And again, reflecting the fact that we've gone up to approximately a 50% target. That's coming up. And then we have a couple other lines here, what our unhedged fuel price results are. And then we're going to lay in a new line with the hedged or unhedged blend results. Again, slight variation there off the unhedged fuel price. I think as we have more data under our belt and more time with it, we'll continue to see improvements there. And then I think there's one more data point, Patrick, to come in.
And if I'm understanding this correctly, the solid red line is the price the fuel ended up.
The hedged price, yeah.
And where's the actual price
That's the dash line. It's slightly higher up there.
That's what the fuel ended up costing.
Right.
So, and the green is the unhedged?
The green is our gallons hedged. The green is gallons hedged, and that's on the left axis. these red lines here are on the right axis, which is our price axis, and so the hedge price going forward are represented by those dots, and that's really, again, that's the budgetary certainty we're looking to lock in, vis-a-vis the solid red line, which is actual prices. Again, that's a hedged unhedged blend of prices there. So where we look to see this going forward is, again, for about half of the portfolio, we're going to be at that red, where those red dots appear, and then the other half is going to vary depending on what the cost at the pump is. Okay, we have one more slide on this, and this is maybe a better way to look at the price volatility. And what you see here on the blue line is price volatility for ultra low sulfur diesel, and then you see what that standard deviation of 1.23% is for that portion. And then the green, we lay in the green, and that's our hedged price volatility, which is slightly lower. So if you lay in the next, what the hedging does is it cuts out the highs and the lows, and again gives us just more certainty in budgeting. And again, this is only for half the portfolio.
There's no question it gives you more certainty. You just want to be on the right side of long term of the hedging.
Of course.
Obviously. There's no question that it gives you, predictability. It's just that hopefully you're hedging at the right price, or unhedged you might have done better in the long run. That's what you have to gamble on, obviously.
It's not, well, I wouldn't characterize it as a gamble. I mean, what it really does is as the budget is put together, and you've got the uncertainty with what's going to happen with fuel going out for the next for the financial plan period, to the extent that you've locked in about half your cost over the next 12 months, it's going to just give you certainty. Whether or not you're going to be better or worse than prices at any given time, you have to be indifferent to that, quite frankly.
Patrick, excuse me, I don't want to belabor this thing, but has anybody ever done analysis going back a year and seeing how the prices were and whether we actually made or lost money on a hedge?
We have looked back.
What does it look like? I mean, I'd love to see something like that, because all these machinations that we're going through here, if it goes up, goes down, in the true end, that we and the cost of the hedge, too.
Yeah, and the hedge cost is a very small amount of money, the actual execution of the hedge. What we're saying is we can look back, and there are times when the hedges have been profitable, if you will. There's been times when the hedge cost us extra money. But the one thing we do know is the more certainty that we have with the actual cost of the commodity, okay, because we have locked in prices, the more we're able to handle everything else in our budget that goes up. When electricity goes up, or when, overtime goes up because we have a winter storm or something like that. Remember, again, we're locking in our fares and tolls for a 2-year period of time. So we really don't have control over our revenue for a great extent. So what we try to do is lock in certain things that are subject to market fluctuations, and those are your commodities. And so, again, to say whether we made money or lost money is less important than did we have certainty in it that we could then try to balance the rest of our budget around. And that really is what drives it.
So we're preventing a surge or something that would knock us out for a couple of months.
But Carl, we had numbers on this. We spent, you might have been ill at the time, but we had spent, no, well, you were out, at that time, but we had spent, but we spent, but we had spent a lot of time, and we actually had all the numbers here, and I'm sure Pat can get them. We had all those. We had all those charts.
Yeah, we have.
Why don't we give them out again, so that we can show what we actually had?
Sure, we'll absolutely do that.
Okay.
Because while I agree with Bob, it's obviously important to have predictability on some of your more egregious costs. You want to make sure you're at least 50% or better right on these predictabilities. Otherwise, maybe you might not want to hedge as much. If it turns out over a period of time that you bet that it was going to be much higher than it actually was, you're actually driving up your cost by that much hedging.
Here, the way to look at this really is, we have a general reserve in our budget that this coming year is going to be 130 million. Okay, general reserve of 130 million. If our fuel costs are $260 million, that would give us the ability to handle a 50% increase in the price of the commodity. But that would be using every bit of our reserve, giving us nothing for any other volatility, considering revenue declines or things like that. By hedging, we're stretching that general reserve and giving us more capacity to absorb, these fluctuations. And so, again, that certainty is everything here. One would say 50% being hedged, it still gives us upside if the commodity price goes down. And that's why when you saw the lines up there, all we're doing is we're mitigating the swings. And we can handle, more easily handle the increase, and we're still taking advantage of the decrease when it happens. We're not getting full advantage on the decrease, but that's a good trade-off for avoiding the upside or the increase. Roughly 50% is our target now of the gallonage.
So what's the one?
So,
I understand that.
Well,
all right, good.
No, they're
But
asking
we'll
something
make the
different.
information available to everyone so that you have it there as reference.
Okay.
I'm feeling fine. You are?
Okay. So, why don't we go to the next slide here? What you can see here are the outstanding hedges by counterparty, and you can see that the gallons hedged is about 31 million gallons hedged. Dollars hedged is about 92 million. On the right, you see the mark-to-market values, and that reflects, again, the theoretical replacement cost or termination cost if we were to get out. Right now, that is actually in our favor by 3.2 million across this whole, all the different transactions across the portfolio. And the one thing we haven't done is we haven't added that new hedge with J.P. Morgan in here, but we'll report on that next month. So again, this just gives us a sense that in the current market, we're to the good of about 3.2 million on a mark-to-market basis with respect to all these fuel hedges. So I think I could answer. Yeah. Okay. So that concludes the derivatives presentation.
Okay, Doug, you want to take us through the semi-annual investment report and station maintenance billing update?
The semi-annual investment report, it's just for your information. It's included in the book. It shows the returns on investment that we had on our...
And Vinay's here.
Vinay Dayal is here to answer any questions if there are any. Just information.
So it looks like Nassau County is still not paying up?
No,
That comes next.
That's
that's
coming next, yeah.
I turned the page.
Right, so next in this section, the station maintenance receivable update. Total amount billed was $157,255,958. We've received all payments with the exception of Nassau County, $27.9 million. However, we've spoken with the deputy county executive, and the payment has been processed, and they expect to send a check is in the mail. And it's also within their annual budget, so we don't anticipate a problem. Yeah.
Okay.
Continuing in this section, we have 10 competitive procurements for headquarters for a grand total of $6,325,489. We need a motion for that.
We need a motion, please, and a second, please. Okay, all in favor? Any opposed? So moved.
Okay. Next, moving to the Long Island Railroad Metro North Committee, we have two action items, both from Metro North. The first one is a New York State Department of Transportation grant for connecting services. So we need to obtain MTA Board to enter a contract to accept $300,000 in a congestion mitigation air quality grant from New York State DOT to support connecting services covering the period October 1st, 2012 through September 30th, 2013.
Motion,
Need a
please,
motion.
moved. Second, please. All in favor? Any opposed? So moved.
The second action we need to authorize Metro North to hold public hearings to set West Haven station fares within the state of Connecticut.
Okay, motion. Second, please. All in favor? Any opposed? So moved.
There are 4 procurements for Metro North and Long Island Railroad. At Metro North, there's 1 non-competitive and 2 competitive procurements for a total of $2,999,286.
Jim's. Second, please. All in favor? Any opposed? So moved.
Long Island Railroad, 1 competitive procurement jointly with Metro North for an RFP amount to be determined.
Move. Second, please. All in favor? Any opposed? So moved.
Thanks. MTA bus operations are next. There are 5 procurements, 1 non-competitive procurement jointly with New York City Transit, and 4 competitive procurements, 2 of which are approval to use the RFP process. These combine for a grand total of $172,196,594.
Second, please. All in favor? Any opposed? So moved.
Next on the agenda, we have Bridges and Tunnel. We have 1 action item for Bridges and Tunnel. B&T is seeking board authorization to enter an agreement with New York State Department of Transportation to provide improvements to the Gowanus Expressway approach to the Verrazano Narrows Bridge, including areas under the jurisdiction of the New York State Department of Transportation, in order to complete remaining portions of a permanent continuous bus HOV lane between the Verrazano Narrows Bridge and the UL Carey Tunnel. We need a motion.
Motion, please. A second. All in favor? Any opposed? So moved.
There are 4 procurements for B&T, 1 non-competitive and 3 competitive, for a grand total of $5,687,664.
Motion, please. Okay. Second. All in favor? Aye. Any opposed? So moved.
New York City Transit is next. There are 4 procurements for a grand total of $4,628,383. 3 are non-competitive, and 1 is a request to use the expedited change order procedure pursuant to Articles 9 and 10 of the All Agency Procurement Guidelines for R179 train procurement with Bombardier Transit Corporation.
Those were all approved at Transit, so I'll move it.
Okay, thanks.
Second, please. All in favor? Any opposed? So moved.
Okay, there are no items for FIMTAC. Included in the book are MTA consolidated reports for both September and October because of actually it would be August and September because we didn't have the book last month.
Okay.
And that would conclude the finance portion of the meeting.
Okay. Jeff, you want to?
I would like to raise an issue before we get to real estate, if I could, because then there's an executive and I don't want to miss this opportunity. Everybody knows that that the MTA and all of its employees went way beyond in getting the system back after Hurricane Sandy, and the thanks have been fully flying here today, and it's well deserved. But there's one group of riders that appears to have sort of been forgotten during this discussion, and that's those who bought time-based passes for a period of time that included the ravaging of the system under Hurricane Sandy. And I'm just wondering, I think it would be right if we, and it doesn't have to be decided now, but if we tried to do something for this group of riders. Many of those riders bought the time-based passes on the theory that that was the best fare option for them, and it's certainly not their fault, it's not the MTA's fault, but it's certainly not the riders' fault that the system was unable to accommodate them during this period of time. So I would just like to say that I think something should be done for the riders that bought the time-based passes, whether it's, with the wonderful cubic system we have, it's easy to determine who that group was that wasn't able to use those fare media during that period of time. I really think some accommodation should be made for them. Much as probably something should be accommodated for the commuter rail riders who had a monthly ticket and who were not able to use the full brunt of that. I appreciate the free days that were given to riders, but these are people that bought this particular kind of fare media with the assumption that they would be able to use it during this period of time, and they were not able to. So I assume that finance is the correct place to bring up this point.
Yeah, I mean, I agree with the spirit of what Andrew is saying. I realize that, that a loss is taking place here and that we're in the process of trying to establish what our own losses are in some kind of a fashion. It would be my hope that we consider this an opportunity if it's possibly reimbursable under FEMA or under insurance or under, and that if we're not able to, I mean, I guess the first thing would be able to directly get the lost revenue or lost expenses back to the riders themselves, but if not, put it into a pot of money to be used for service enhancements, in the future, as just in recognition that it's ridiculous for millions of people to put in a claim for a couple of dollars, but if we could use it as a pool of, in the aggregate, it could be a significant amount of money. I know that there are people, that the argument was, well, we didn't charge for 3 days, during that period of time, but there were some people who had no access to the system at all. Other than, perhaps the local bus routes that were nearby them. I know that Staten Islanders couldn't get off the island because the boats weren't running, and that it was very difficult getting across the bridge with the restrictions that were, well, first it was closed and then the restrictions that were put on it. So getting access into the system was an impediment, and I'm sure that there are many people who are in that situation. So if at least that could be considered as part of damages to be in the construction of the hull. Thank you.
I think that this is good points, and I think it should be noted by the committee, and I'm sure Joe is here listening, and I'm sure we'll hear more about this in the future, and I think it was worthwhile bringing up.
Thank you.
Is that, Joe, do you want to say anything else? Okay. Okay. Now, Jeff, would you take us into the real estate, please?
Thanks, Andrew. There are 8 action items for your consideration this month, including 7 that were in the book and 1 that you have before you now. Just 2 items to highlight. One, I want to call your attention to the staff summary for Starbucks. That's a renewal at Grand Central. Very, very pleased by the rent there. It's $500 a foot. That's more than twice what we were getting before we were getting under combined base rent and percentage rent, and I think it's a testament to the, let's say, the forward momentum we have in continuing to build that shopping center. So that's a great result for us. The other thing I wanted to talk about is the West Side Yard contract modifications that you have in front of you. Let me just take a minute to, I don't mean to overstate this, but celebrate this moment. I think, we've been talking about West Side Yards for a very long time. The proceeds of that transaction represent a very important piece of our capital program. For perspective, the RFP was issued in 2007, and there was a competitive process that resulted in a selection of Related and then Goldman just before the crash. After the market headed south, a decision had to be made what to do. This board in 2010 made, I think, a very good decision to enter into agreements with a joint venture of Related in Oxford. You'll recall that the essence of that deal was that we locked in the pre-crash economics, that is to say, present value just in excess of $1 billion of revenue for the MTA under leases to be entered into. But from the developer's point of view, the quid pro quo for maintaining the old economics was that they didn't have to close until certain indicia of economic recovery had been met, and there were 3 of them that were summarized in your old packages. Those so-called triggers are not yet on. They do not promise to be on until sometime next year, if then. So that is to say that Related and Oxford are under no current obligation to close. However, I think our judgment in entering into the contracts with them have been entirely vindicated. They've been marketing the property aggressively. They've been, designing every bit of it. And as has previously been announced, they've attracted some prominent tenants to the development, most notably Coach, which is prepared to put its world headquarters in a new tower at the southeast corner of the site. That's just at the end of the existing part of the High Line. That's a 1.7 million square foot office building, and the developer is ready to proceed with the work on that site. They are not yet ready to close on their financing. They have identified sources for that financing, both debt and equity, and they expect to have all those arrangements completed within the next month or two. But because of commitments that they've made to Coach and other prospective tenants, they're very anxious to get started, and they're prepared to go at risk to the tune of about $50 million that they will guarantee completion of certain preliminary site work, excavation, foundations, and the like, and commit, and this is the most important point from our point of view, to a firm outside date for closing of no later than June 1. So in other words, the contingencies in the contract that exist now relative to the so-called triggers are to be eliminated, and June 1, I think, represents, frankly, an abundance of caution on their part. Their intention is to close within the next month or two, and what we have insisted upon, and I think this is detailed in your staff summary. We feel very good about this. In all respects, the economics of the transaction will be preserved as if they were closing now. So that is to say, they will start to pay us rent on the portion of the site that relates to this tower. They will be paying us the $17.5 million deposit that we've been holding in escrow. Irrevocably will now be converted to cash, and then when we close, all of the dates in the leases and so on will date back to the date of the start of the early work, so that on a present value basis, we'll have our $1 billion as of, call it December 1, as opposed to sometime next year. And that's, very significant for us. And indeed, it gets even better for us if, for some reason, they delay. If the closing happens after February, it starts to cost them more money. So there are no perverse incentives there. We're very comfortable that they are, in fact, moving rapidly toward a closing. So I very enthusiastically recommend to you these contract provisions and look forward to an imminent groundbreaking.
Jeff, do you need one vote for all these, or how do you want?
If we could have a vote for the 8 action items, I think that's how we usually do it, if that's okay.
There's really no downside to this from your perspective.
None that I see, no.
Can't beat that.
Not, if for whatever reason, decide that they weren't going to go ahead once they had done some of this preliminary construction, it would not affect our operations.
No, this is, thank you, Jim. This is actually on what we call terra firma, that is to say the portion of the site that is south of the yard, so they are not starting the platform work per se. And if, as you say, the world were to go crazy and they couldn't go forward, what we would have to show for it is the completion of this site work that improves the value of our site, plus some more money as detailed in the agreement. Yeah, John.
You're proposing that we adopt the resolution that was submitted to us. Are there any other actions that we have to take under any other laws, environmental or other types of laws?
No, that was all done in
with respect to this?
2010. We
don't have to
secret and
update
so
any
on
of that?
no.
Okay,
No, it's the same plan.
thank you.
So we have a motion. We have a motion, we have a second. All in favor?
Aye.
Any opposed? Yeah, certainly. Okay, let's note the records at 1G. Okay. So the motion has passed.
Thank you.
Jeff, thank you very much. Now we need a motion to go into executive session, please. Motion, please. Second.
remember it.